Hey guys, welcome to the channel, the Danko Financial YouTube channel. I wanted to kick off the channel by doing a stock analysis on one of the most common stocks for young retail investors, one of the most well-known companies, especially stocks in the investing world as of the last 2 years, and that is Tesla. The stock ticker is TSLA. So first and foremost, want to show you guys obviously the stock's price movement. Obviously, we can look. We see the last 5 days; it's down about 1.5%. Not much overall movement the past month. However, the past 6 months, it is up 73%, and year to date, 50%. And then lastly, over the past year, it is up nearly 100%, which is absurd, especially given this massive market cap number. So just obviously a little intro there, and we know obviously where the price is currently. It is over $1,000. This is post-split. So dating back to before the split is actually where we're going to start. We're going to start back in 2019. The reason I say that is because that's when we saw the first run-up of the price on this stock. All right, so this is right around July, August timeframe, 2019. Obviously, this is before COVID hit. So we see the price hovering between 250 and 200 until it breaks past 250 and then shoots right up to above 300, and that's really when the run-up commences. This run-up lasted through the end of 2019 into the very beginning of 2020, bringing the price all the way up to $900. Again, that is pre-split price. The split was here, the 5-to-1 split that occurred at the very end of August in 2020. That's the split there. That's why you see the price dipping down at that point. However, like I said, this is pre-split. The stock had increased and brought itself up to $900 per share. All right. Then we see COVID obviously take a massive toll on Tesla until the V-shaped recovery occurs, in which Tesla then increases with a significantly higher run up all the way to over $2,200 per share. All right, at that point, they obviously did the 5-to-1 stock split, and from there, it was somewhat stagnant. It increased, then remained stagnant until we once again saw another increase. Now, keep in mind, of course, as we're looking at this, even though this looks like stagnant and it looks like there's a massive drop here, this is, of course, the price without taking into account the stock split. So what I mean by that is that even though the stock price at, let's say here, is 880, that's the beginning of 2021, and the stock price at the beginning of 2020 is 900, the market cap on these two different time frames are obviously completely different, right? The market cap here, even though the price is the same, is nearly 5 times what the market cap is at this point here. All right, the reason I wanted to show you guys this chart is because if we go back to the price movement on Tesla on one of these charts here, so this is the chart just from Google. If you look up TSLA stock, you'll find this. If we looked at, let's say, end of 2019, let's see where it would be. Yeah, right here. End of 2019, you'd see $70, but you'd think in your head, I don't remember Tesla stock ever being $70. Well, the reason is because this is with the split incorporated into the price. So we can see the run up here. However, just so that it all makes sense, basically, you all remember that at the end of 2020, the end of 2019, it did shoot up from this $250 price all the way up to here and then down. Of course, again, like I said, these numbers are without the split. Well, they're with the split incorporated, but take them with a grain of salt. So without confusing you guys, what I want to mention specifically in this is that, this price here at $1,081, this is as of the most recent close, which was November 26th, 2021. We multiplied that by 5. The actual price that we would get, assuming that there was no split at all, would be $5,410 per share. All right. So that means that since 2019, if we take about 250, we're looking at a price increase of about 20 times. All right. And so when we're doing these stock analyses, we need to figure out whether or not that increase is truly justified and how Tesla as a company has grown since 2019 all the way to now to see if that price is really realistic in any sense. All right. So taking a look at some of the numbers on Tesla, right? So in 2019 here, right, we see a market cap as of the very beginning of December, which is about where we are now. The market cap was about $60 billion. Okay, that was right before the actually is right during really the run up, because the run up started right around the October timeframe in 2019. But still, we see a $60 billion valuation. Now the revenue here is, as you can see, $24.5 billion with a net income. Don't forget the negative sign on the front. That is negative $862 million, a loss of $862 million, right? And that is including the revenue from $594 million in regulatory credits. Tesla is essentially a zero emissions company. Therefore, they do receive a large number of regulatory credits, or a large value in regulatory credits. This year, they were given or they sold basically the revenue from their regulatory credits selling to other car manufacturers totaled about $600 million, meaning that their actual losses from their products, from selling their products, which are their vehicles, probably were somewhere closer to the $1.4 billion in negative net income. So just keep that in mind. These regulatory credits being incorporated in this net income, even though, again, this net income was negative. Now, flash forward 1 year to 2020, and we see a market cap as of a year later that has grown by nearly 500, just about 500 on the dot, $500 billion. All right. So this is where we determine whether or not this is really justified, right? So from 2019 to 2020, there was a $500 billion increase in market value, meaning that the market sees this as $500 billion more, worth $500 billion more than it was just a short year ago. Now the revenue increased to $31.5 billion. The net income actually resulted in a positive number. However, the revenue from the regulatory credits actually grew to $1.58 billion. So once again, if we were to leave out the regulatory credits, this company would be negative. I think it'd be negative by somewhere around the 800 million-ish range. So obviously, again, that's an increase from what would have been a negative $1.4 billion loss, but it is still negative. Now, obviously, their net income shows positive. Again, this is because the revenue includes the regulatory credits. Just keep that in mind, because these regulatory credits, as you'll see in 2021, are starting to decrease. And at some point, they may suck up and dry up completely. And so it's important for us to keep that in mind, especially when looking at Tesla's numbers. Now, does it make sense that Tesla grew $500 billion in market cap with only a revenue increase of $31.5 billion from $24.5 billion, and then with a net income that's positive versus a negative net income? Obviously not. There is really these numbers have no correlation to these immense growth numbers. Of course, not necessarily that we needed to see a revenue that was just about 10 times what this is. That would obviously be completely out of the question. But this minor growth is really not in any way, shape, or form showing a proper increase. Now, we do have to keep in mind here too that 2020, and I'll, to Tesla's credit, they still grew despite the coronavirus, which is still very impressive. And I will I'm certainly willing to kind of give the benefit of the doubt to them in that regard. However, same thing, this growth in no way justifies a $500 billion valuation increase. Now, we go one step further, looking at this most recent year, this year, 2021, as we're approaching just about the very beginning of December, the market cap is over $1 trillion. So nearing once again a $500 billion increase in valuation, and we see the revenue has, I'm projecting about $50 billion. The reason I say projected, and the reason this number here, the net income, is projected, is because we've only seen the quarterly reports up to quarter 3, so that's Q3 of 2021. And so as of now, they've reported 36 billion through the third quarter. And like I said, based on those numbers, I'm projecting they'll be at about 50 billion in revenue this year. In terms of net income, they've reported thus far 3.1 billion through Q3. And I'm projecting that they're going to be somewhere near 5 billion. The revenue from regulatory credits, I think this year will total about probably just shy of 1.5 billion. So not actually a giant increase from last year. As of right now, they reported 1.15 billion through the third quarter. So again, like I said, these are projected numbers, but I'm thinking it's going to be right around 50 billion in revenue and a net income, net income of 5 billion. If we were to take away 1.5 billion from this, and the regulatory credits, again projected 1.5. They'd be right at 3.5 billion in profits. Now, what's important is that they were profitable regardless of the regulatory credits this year. That's obviously something that we want to see from a company like Tesla. However, and even with a pretty impressive revenue increase here, I really don't think the numbers are there to justify a $500 billion valuation. I mean, this is just really the common sense argument, right? Do you guys see whopping numbers that show amazing growth? Well, you can look at the net income and say, hey, well, it went from 721 to 3.5 billion, to about 5 billion if we're looking at those, including the regulatory credits. That's obviously impressive. There's certainly nothing against that, and I don't want to say anything against that. That is a nice profit margin to see off the 50 billion. But does it justify a $1.09 trillion market capitalization number? I think not. I think when I show you guys the comparisons, you will agree with me. Now, delivery numbers in 2019 were about 367,500. 2020 increasing to 500,000, not quite double, but if this year didn't include coronavirus, I'm sure they'd be closer to that doubled range. And then in 2021 thus far, they have reported 627,500 deliveries. I'm projecting over 900,000, which is a very fair estimate, which is near double in that regard. So have to give some credit to them that the growth from these delivery numbers is certainly impressive, but obviously the more they offer, the tougher it gets, I think, as a whole. The more they deliver, the tougher it gets for them to continue to double or even to near double, right? One thing that's important to remember too is that Tesla for the longest time has been really the sole provider of electric vehicles. Now you're seeing the large car manufacturers, GM, Ford, even some more, some higher end brands like, for example, Porsche. They're all offering electric vehicles. I know GM is aiming to go all electric. I believe it's by 2025, maybe 2030. I'd have to look into that. But you're seeing a lot of car manufacturers shift over to electric vehicles, and we're having new companies spurting up every day. Companies like Rivian, which is actually very recent, but then NIO, Li Auto, XPeng. Those are all Chinese companies. The Chinese EV market is a massive market for electric vehicles, and so if Tesla wants to achieve the growth that they're looking for, they really need to own that market. And as of right now, it's showing that the market share for them is decreasing in China versus these other companies, these Chinese-based electric vehicle companies. So the competition is steadily growing. So keep that in mind, that these delivery numbers are really, I don't want to say uncontested, but they are really not. This growth is without major players going fully auto, and when they do, I'd really be curious to see how Tesla fares in the market. So as we continue on, we look at some comparisons to car manufacturers. Now, I will take a look at this two different ways, right? So we will compare to car manufacturers, and then for those of you who believe that Tesla is a tech company, we'll also compare to the tech companies, some of the tech giants. So just so I can give you a brief overview and an understanding of just how highly valued Tesla is at this current point in time. So General Motors, we take a look at them, anticipated, again, this is all through user projected numbers based on what I've seen from the quarterly reports through Q3 of 2021, we're looking at General Motors an anticipated 2021 rev of between 119 and 123 billion. Anticipated 2021 net income between 10 and 12 billion and a market cap of 87.36 billion. What is the major important, or these are all majorly important numbers, but what I think is most important is to show here is that not just the revenue, but the net income is double. It's going to be over double, I believe, over double what Tesla has produced this past year. The revenue is over double, and the market cap is not even a tenth. So the market values General Motors at not even a tenth of what Tesla's worth, even though their net income is over double and their revenue is far over double. So example number one presented. Now Ford, same exact scenario here, right? So they're doing over double in revenue. They're not quite at double the net income. Their net income has been a little bit inconsistent. If we actually go over to their ticker here, this is actually where I get all the information, but a lot of it. If we look at their Q1 report here, we see a net income that was actually pretty nice. Q2, I'm not exactly sure what happened here. I might have to look into it, but obviously a big decrease from 3.26 billion in net income to then just over 500 million. Not sure about that. And then we look here and we see that Q3 is at 1.83 billion. So food for thought, keep that in mind. But even still, looking at a net income of over what Tesla produced, same thing, market cap is, and I'll show you guys also where you can find market cap just so you guys know for your own reference. Market cap here is just about 79 billion, 78.93 billion. Once again, not even a tenth of what Tesla's market cap is. Now, Toyota, one of the largest car manufacturers, if not the largest car manufacturer in the world, doing revenue, I'm projecting between 268 to 271. Net income, this is a large range, obviously a plus or minus of 5 billion. But even still, somewhere in that range. And then a market cap currently of 290.67 billion. Quick note on Toyota, their numbers are calculated in the Japanese yen because they are a Japanese company. So just make sure that you, when you're doing analysis on certain stocks, especially this stock, you realize that a revenue of 7.55 trillion in a quarter is clearly very unrealistic. So make sure that those numbers are converted. And my numbers are in, of course, US dollars, but even still, this company is doing over 5 times the revenue, roughly going to be 5 times the net income, and their market cap is almost a third, actually not quite a third, of what Tesla's market capitalization is. So those are 3 comparisons from car manufacturers that I hope show you just how overvalued Tesla is. But for those of you who are still not convinced, we go to the tech stock comparisons. Now, in this case, what I ended up doing for the tech stocks to make the comparisons a bit more realistic and a bit more fair, I chose the price to earnings and the price to sales ratios of these companies because obviously Apple, Microsoft, and Google sell different things, different products, different services. Wouldn't really be fair to compare the revenue numbers and the profit numbers. So I wanted to look at the ratios and show you guys the differences between this and Tesla. So to give you guys just an idea as to what these ratios mean, what fair numbers on these ratios would mean, I'll actually show you where I find them. I use a website called Macro Trends. Yeah, it's a bit heavy in terms of the ads, which is a little bit annoying, but you close enough of them out, you can go over here. You see here it says Apple PE ratio 2006 to 2021, stock ticker is AAPL. We look here, it explains to you what the PE ratio is, just for anybody who basically doesn't know what it is. The purpose of it, which as you can see here, the PE ratio is a simple way to assess whether a stock is over or undervalued and is the most widely used valuation measure, which is what I'm obviously using to compare, right? We see a PE ratio of 27.9. Now, this ratio means nothing without a comparison number. So high flying-ish tech stocks, but the larger tech stocks are usually sitting in at a PE ratio between 20 and 25. All right, so both these numbers, the lower they are, it's like golf. The lower they are, the better. So Apple, right at about just shy of 28 here with a PE ratio. Would like it to be between 20 and 25, but 28 is where it's currently sitting. And then the price to sales ratio. This number, once again, the lower the better. The best value it could be at would be 1.0 completely, because that would mean that the price of the stock is equivalent to the sales the stock does or the company does in the most recent years. So the revenue number equates to the stock price in the sense that the valuation is very similar, if not the same, as the revenue, the sales generated by the company. So we can see here two numbers, right? Price of sales 7.26. Apple's price to earnings is 27.9. We look over at Microsoft, we see a bit of a high price to earnings and price to sales ratio. They've been on a bit of a run up lately. So, just kind of a brief side note mention there. Maybe that's another stock I could do an analysis on. But we're looking there at a price to earnings ratio of about 40 and a price to sales of 14.5-ish, which is essentially, not necessarily double the price to earnings, but almost double. Actually, about double the price to sales ratio there of Apple. In any case, not what we're looking at, just using this as comparison. And then we look at Google, who has very similar numbers to Apple. Now, again, the lower these numbers are, the better. I will mention that if we want to look at a company that has a really high PE ratio, we can look at Amazon. I'll just tell you right now, so just looking at it, the Amazon price to earnings ratio is about 70, which I think is pretty, it really is astronomically high. However, they have actually maintained somewhere between 70 and 90 the past maybe 5-10 years, maybe more. So with that in mind, they've been able to maintain it. People have enough hope in them to carry out that number and to see it as realistic and plausible. Therefore, that is just a piece of reference for a very, very high price to earnings ratio. Now we shift to Tesla and bam. I mean, look at that. Right there, you see, I said 70s high. Well, Tesla has a price to earnings ratio of 350 and a price to sales ratio of 25.74. So, of course, to put that into perspective, I'll move these closer here. Just wanted to spread them out for the added effect. If we look at the price to earnings ratio here, I mean, assuming that Apple is at 30, the price to earnings ratio is it's over 10 times what the price to earnings ratio is for Apple. And the price to sales ratio is over 3 times, which are both very, very, I'll say, not good signs for the valuation of Tesla. So again, for those of you who have said, well, Tesla should be valued as a tech stock, well, here are what the tech stocks are sitting at, the tech giants. Here's what Tesla's sitting at. So you tell me if even a tech stock valuation comparison makes any sense at all. All right. So now we go into something that I like to look at, but something that you guys are probably interested in as well. You guys may be surprised by these numbers, but I would like to show them to you anyways. This is my price target for Tesla. I'm assuming, these numbers will start to accumulate probably towards the back end of 2022, if not mid 2023. It really depends on when interest rates begin to be adjusted due to the hyperinflation that the economy is currently facing. I think that could be sooner rather than later, with check downs probably starting by the Fed as early as next year, so 2022. So assuming that the revenue of Tesla reaches about 70 billion, this is what most analysts are projecting. I think with the economy slowing down, I actually don't think they'll hit 70 billion, but giving them a fair shot here and being maybe aggressive with the revenue growth, them going from 50 to 70, given even the fact that there's hyperinflation and a slowing economy. With a projected EPS that comes along with it, analysts are predicting about 8. I think it's relatively fair, but assuming these numbers, my price target, I've actually built 2 price targets here. One that's between 225 and 250, This would match Apple's valuation. Their price to earnings ratio is, like I said before, about 28. So this would put Tesla at a price to earnings of about 28. Again, assuming an EPS of 8 here. And again, like I said, just mentioning that 70 billion in rev that I'm projecting here. So between 225 and 250. And then if we were to be on the high side, so the high flying side, similar to Amazon's valuation, the price target would be somewhere between 500 and 550. So before most of you guys say, what the hell, this is a terrible price target range, I bring up both of these just to give you guys an idea. It really depends on how the market values these. To be totally honest, I'm more on this side. I'm more on the between 225, 250 or worse. And then from the standpoint of 500 to 550, well, if the market's not convinced that the stock should go lower than these numbers, then this is where it'll sit. But like I said, by end of 2022, mid to late 2023, I expect the numbers to be, at the very least under 550. And I think that that's very, very conservative. I think if anything, the range will be, far closer to here. All right. So not that I am advising any particular financial decisions. However, if you are an options trader, especially interested in put options, long-term put options, I may consider, and the only problem with this is that the premiums are so high, but I may consider, puts that expire long term, probably in 2 years at a strike price of about 550. I really can easily see it going below that. And if anything, if you're lucky, if you are somebody who gets into a few put options, buys a couple contracts for that, it could float into this range or lower, of course. So keep that in mind. So that concludes the video today, guys. I appreciate you guys tuning in. If you like this video, please give it a thumbs up and subscribe to the channel. I have also started a podcast. So if you would like to hear these videos and hear the audio and whatever in your daily life or as you're out and about, doing whatever, going about your usual day. If you'd like to hear these videos, please check out my podcast. It is also titled Danko Financial. You can look it up on Apple Podcast or on Spotify. So again, thank you guys for the time. I appreciate it. I look forward to more stock analysis videos. If you guys have any requests, please feel free to leave them in the comment section below. And I will see you guys in the next video. Take care.